the best way to answer that really is dependent on the type of investment structures that they have into the PRC. Most of the deals that we work on are bond structures, but they're what we call offshore bond structures. So typically the company issues debt through a Cayman, perhaps Hong Kong vehicle, and the bonds are issued to offshore investors, typically hedge funds or asset management companies. And unfortunately, the way that these products are structured is that they don't normally have any recourse directly to onshore assets. What they have is most likely some form of collateral over offshore shares, so either the issuing company being a Cayman or Hong Kong company, and also usually intermediate holding companies, which are often BVI or, again, perhaps Hong Kong holding companies, intermediate holding companies. But what they don't have is real security, for example, in the form of mortgages or other fixed charges over the actual assets, which are often and almost always owned by the onshore subsidiaries in the PRC. What that results in is what we call structural subordination, which is the fact that from a capital structure perspective, the recourse of the offshore lenders is really just to holding companies and not to the underlying value, which is always in the operating subsidiaries, which actually own the factories, the real estate, or frankly the business that you've ultimately lent to. And if those onshore assets have themselves been collateralized or mortgaged to onshore lenders, which is increasingly the case, it means that in a distress situation, it's very, very hard to get to those assets because the onshore lenders will usually take some form of enforcement action to realize their security and to get value for themselves. And of course, they are not really that interested in the offshore piece at that point in time, and thus the outcome for the offshore creditors at that point can be problematic.